Okay, so what are the main risks out there in the investing world that we need to be cognizant of and try to manage in our portfolio? Okay, top left, market timing. Yeah, everyone, that's when you move all your money out of an invested position over into cash. You know, it sounds easy. If you think the markets are going to go down, just put everything in cash and then when it bottoms, buy back in. Well, if it was that easy, everybody would do it and everybody would be, you know, retired on an island. But it's not. And so we believe in an asset allocation approach as opposed to market timing. Currency risk. We talked about, you know, the long-term potential weakness in the value of the dollar. So it's wise to diversify some outside of dollar-denominated investments. Political and economic risk. You know, they're seeing this over in Greece right now. You know, they've overspent for years there, and I read yesterday that Greek bonds may have to be revalued. S&P is saying that 70% of the principal could be written down on Greek debt. So we always have to be cognizant of what the politicians are doing and what the general economic situation is. Liquidity. Liquidity risk means how easy is it to convert your investment into cash? You know, with marketable securities, it's easy. With something like annuities, which I don't believe in, it's tough. Limited partnerships, no liquidity. Direct real estate, very non-liquid. So there, you know, if you need to have the ability to convert your investments into cash, liquidity risk is important. Call or reinvestment risk. How many in the room own municipal bonds or municipal bond funds? Okay, a few. So you may know that bonds can be called in by their issuer before the maturity date, and this is very prominent with muni bonds, and you get all your principal back. So this nice coupon, this maybe 4 or 5% interest you've been earning, all of a sudden goes away and you get your money back, and then you go to reinvest at today's rates, and it's sticker shock. Interest rate risk refers to the price of existing bonds and what happens to them if interest rates go up. And we'll talk more about that in a little bit. Market risk, that's general market risk. Industry or company risk. You know, this has been something that has dogged the financial industry lately. The Dodd-Frank Act that came down last year that is trying to, you know, take care of banks and restrict their activities. That has brought some risk on that industry. The healthcare industry with the big Obama healthcare legislation. Government interference can really bring on specific risks to an industry. Credit risk. Credit risk is the risk of default. All right? So you always need to, before you invest, think about, you know, how strong is the person that I'm giving my money to, the institution, the issuer, and what is the credit risk. And then lastly, inflation. Right now it's low. Anyone know what inflation has averaged?
3%.
Since the mid-20s till today?
About 3%.
About 3%, right. Right now we're running between 1 and 2. It has not been a problem in recent years, but we'll look at a slide later to show you that it's like the silent, you know, destroyer of wealth in a person's portfolio. And you have to have some type of hedge in your portfolio to help combat the effects of inflation. Okay, so for fixed income securities, These are the main areas that we're going to go over today. Cash and cash equivalents, which are the safe areas. That's where your principal will not decline, where your principal is fixed. All right? Then we're going to talk about bonds. We're going to talk about individual bonds, individual issues. We're going to spend a couple minutes on preferred stocks, which really act like long-term bonds. And then we're going to talk about different managed bond vehicles. Bond funds, which like traditional open-end funds, closed-end funds, and then also ETFs. And I'll give you some examples on those. Okay, for cash and equivalents, again, the highest safety. Treasury bills are the risk-free benchmark of the world. Even though the dollar has been under pressure, the treasuries, U.S. Treasury securities, are still considered the safest securities in the world. And T-bills, being short-term, direct obligations of the U.S. government, are the risk-free benchmark. But you look at the yields today, and T-bills are issued in different maturities up to 1 year. You can get 0.34% on a 1-year Treasury bill. There's a price to be paid for safety. When we had the big problems in 2008, there was this huge flight to safety, and the Fed brought interest rates down to near zero, and that's where they've stayed. And in the last announcement after the Fed meeting a couple weeks ago, Mr. Bernanke stated that they intend to keep rates at this low level for an extended period of time. Goldman Sachs is saying they don't see the Fed raising rates until after 2012. So it's presented a real problem for savers that have traditionally kept money in Treasury bills, in bank CDs, because if CDs are coming due these days, you know, you go to renew and it's like, you got to be kidding me. So we're going to look at some good alternatives for you. Bank account, CDs, money market mutual funds. How many in the room have a brokerage account with a discount broker like a Fidelity, Schwab, or TD Ameritrade? Okay, a lot of people. Great. You know, that's the smart way to manage your money. I mean, if you have an advisor, then you've got a brokerage account there. You know, your money market mutual fund is part of that account. That's your cash. That's your safety valve. It's always wise to keep a certain amount of your portfolio in cash. You know, 5 to 10% is a good rule of thumb. To put the interest rates of today into perspective, this shows since 1954 what the average has been. Like the Fed funds rate, this is the short-term rate for overnight bank lending that the Fed controls, all right? It's averaged 5.4 over this time period. Right now, it's 0 to 0.25. All right, 1-year treasuries have averaged 5.5. As we said, right now, they're 0.34. Intermediate governments, that's a 5-year right there, 6. Now they're down. I saw the 5-year Treasury yield today, 1.9. Long-term governments, that's a 20-year yield. The average is about 6.6. Right now, you're about 4.25 on a long-term Treasury. So way, way, way below average. But a lot of people are surprised that interest rates have stayed down this long. You know, until the economy can generate enough strength, until we get consumer spending back up, and confidence back up, jobs, hiring, incomes back up, we're going to be, I think, confined to this low interest rate world. Again, the Fed is in no hurry to raise rates because the housing market needs rates to stay low in order to start to generate, some type of activity. So if we move out of the cash realm, then we get into bonds. So we're going from no risk to low risk with these fixed income securities. And a bond is nothing more than an IOU. We give our money to an institution and they give us a bond that's simply a promise to repay at a certain date, which is the maturity date, with interest. It's that simple. All right, these are the 5 main types of bonds that we can choose from out there in the marketplace. Number 1, U.S. governments. So the bills are short term, then we have notes, which are intermediate term, and bonds, treasury bonds, which are long term. And as we see here, the 10-year treasury yield is 3.19 right now. Again, that's another benchmark yield that all bonds price off of. Because again, treasuries are considered to have no credit risk, AAA rated, and so that's just where things price off of.
Scott, do you have any U.S. government bonds long-term in your client's portfolio?
We have very limited exposure there right now. We did take a position in TLT, an exchange-traded fund, which owns long bonds, a couple months ago when rates had shot way up. And, if you look back at 2008, when the stock market and basically all asset classes were crushed, what made money in 2008? Treasuries. Treasuries and gold. So there's a safety factor in treasuries, and the belief in our firm is that this we're in a long-term bottoming process with interest rates that could take several quarters, and so we're looking at this as a short-term, more tactical play as opposed to a long-term hold, and so far.
So you have a small amount?
Small amount, yes.
And when you say small, does that mean 5, 10%?
No, like 2.5.
2.5, okay.
Yeah. How about TIPS? Anyone here have TIPS? TIPS are Treasury inflation protected securities. They have a nice ring to them. The government came out with them a little over 10 years ago, and they basically have done nothing but go up in price since then. And so they are very overvalued at this point in time. And you can get a 10-year TIP today, and you get 0.65% for your yield. Okay? But the thing is, so you say, well, why wouldn't I want to just buy a regular straight treasury and get over 3%? Well, because with the TIP, your principal increases by inflation. So it's a good inflation hedge, but one of the problems is that the CPI doesn't capture all of the inflation that you and I experience. So I would not touch TIPS at all today. All TIPS right now are trading at premiums.
So you pay more. Okay.
So they're issued at par. Okay. But they have all gone to premiums.
Okay.
So prices are way up, yields are way down. It's dangerous, very dangerous now.
Okay.
The government, what I would do is I would keep an eye on the government auctions. The Treasury auctions new TIPS periodically, and you can, watch that, monitor that, and if we've gone through a period where bond prices have come down and yields have gone up, then that's when you want to get interested. Okay? Muni bonds, we're going to go into in a little more depth in a few more slides. The big draw with muni bonds is that the interest that they pay is tax exempt. And there have been some issues with munis that we can also talk about. Corporates. Corporate bonds come in basically two varieties, investment grade and high yield. Investment grade corporate bonds are from well-established companies that have a record of strong profits for year after year, and your yields are lower. High yield corporate bonds are also referred to as junk bonds. And with junk bonds, they are from less seasoned companies that don't have a long operating history. They could still be profitable, but they just haven't earned an investment grade credit rating. And so you are compensated with a higher interest rate and a higher yield with less seasoned corporate bonds or the junk variety. There's been a huge rally in corporate bonds and very little value left right now. So I would definitely discourage any new investing in corporate bonds these days. Mortgage-backed securities. This is one area that is still very ripe for the picking. There's been a recovery here also, but with the housing and credit crunch that we had, the mortgage-backed securities market was also taken out to the woodshed and just tar and feather. And so if you are not familiar or do not have any mortgage-backed securities in your portfolio, it can be a very complicated market. So we use an actively managed fund in this area called DoubleLine, and I'll go into that a little later.
And
But
how much percentage-wise in a person's portfolio would you kind of consider as far as a range is concerned?
well,
I know
you
it's-
have to be careful right now because we've had such a big run-up in so many different asset classes.
Uh-huh.
But this is one area where there's still opportunity. So
5,
we're
10%?
overweighting now, and we've got up to 15% in this area.
15%.
Yeah. Lastly, foreign and emerging market bonds. Our friends at PIMCO in Newport Beach are big on emerging market bonds right now. We are lightening up in that area. Again, it's just like corporates. The prices have gone through the roof, yields have come down, and there is risk there. There is a lot of risk there at these levels. And so, if you own emerging market bonds, you may, depending on how much is in your portfolio, and again, like 5% is a good target here, but it may be a good time to do some rebalancing, trim some profits off of those, because they are trading at near record high prices today.
Scott,
Yes.
are these considered asset classes?
Uh,
What's the terminology?
No, bonds would be a broad asset class. These are like, kind of like subsectors within the bond asset class.
Okay, but if you're looking for diversification, this is the areas that you need to look at.
As far as your fixed income securities, right?
Okay.
Definitely.
And
This is a long-term view of bond market performance. Looks at what $1 invested back in 1926 would have grown to in these different areas. The bottom one is the safe treasury bills. That's a 3.6 return, annual return for treasury bills. Muni bonds, 4.3. And remember, that's tax-free. Government bonds over the years have returned 5.5, corporates 5.9, and as you would expect, high yield 6.9. So, some volatility, obviously, with the bonds, the treasury bills. You know, again, it's just a straight line with no risk. Again, the high yield corporates are very rich today, and the same applies to the high yield bonds. As I mentioned earlier with emerging markets, we just sold out of the majority of our high yield bonds in the last couple of weeks, and you know, took profits. This is a great chart that again goes back to 1926 and looks at the relationship between bond prices and bond yields. Okay? The orange line on the top is bond prices, and the bottom line, the yellow one, is bond yields. So what we see is that from the mid-20s up until about 1945 or so, the end of World War II, bond prices went up and yields went down. We then we had a little, basically till about the late 40s, yields stayed really low. Then we entered a 30-year period of rising interest rates. And when interest rates in the market, long-term rates, go up, bond prices come down. So it all culminated in 1980 when Paul Volcker decided to break the back of inflation, raised interest rates, and that started the long bull market in bond prices and brought yields down to current levels. This again, and I think we're in a longer term bottoming process here, but clearly you can see the risk that exists in bond prices, and this is most pronounced in longer term maturities, where you see this. Another way to show it would be because this is critical. If you're a bond investor, especially in bond funds, how many in the room own bond funds? Really? Okay. Well, let me illustrate it with just an individual bond. But it applies whether it's an individual bond, a bond fund, an ETF, any bond vehicle. You're gonna experience this. So let's say we're going to put $10,000 into a 10-year U.S. Treasury. So we feel that we like the safety of the U.S. Treasury, and that we think interest rates are going to stay low for a long time. So we said, how much for a 10-year Treasury right now?
3.19?
Yeah. Okay, so let's say 3.2%. Okay? All right, so that's stamped on the bond. That's our coupon. How often do we get paid that 3.2 annual interest rate with an individual bond? How often does the interest get paid?
Every 6 months.
Every 6 months, semi-annually. Correct. All right. So let's say a year from now, the economy has continued to weaken. The Fed has stayed on the sidelines, remained accommodative, and that the government is auctioning these bonds, and they're at like 2.5%. Well, guess what? You have to keep a straight teeter-totter. So your bond with the 3.2 coupon is going to be up here, and it's going to be quoted at around $11,000 or at a premium. All right? On the other hand, let's say inflation gets out of control, the Fed starts raising rate, and so 10-year Treasuries a year from now are at 4.2. Well, if you've got one at a 3.2 coupon, and guess what? And it's got 9 years left till maturity, it's going to be marked down to a discount and going to be worth roughly, say, $9,000. So the point is if market interest rates go up, the prices of existing bonds go down. Okay? Very critical to understand. So how do you get around this? You own shorter maturities, which are less subject to interest rate risk, or you buy individual bonds and hold them till maturity.
What is the average duration in your client's portfolio, or what are you buying out today as far as maximum duration?
Maximum duration, and does everyone know what duration means? It's another word for maturity. It takes into account the cash flows on the bonds. Around 8 is the maximum. Our average, I would say, is closer to the 4 to 5 range at the most. Yeah. So if you go to buy individual bonds, this is what you need to know. Who's the issuer? You know, that's really the most important thing, is your comfort level with the issuer. And because that's your source of repayment. The coupon, again, that's the annual interest rate that's stamped on the face of the bond. Every bond has a maturity date, anywhere from 1 to 30 years. You're going to get higher interest on longer term bonds because you're giving your money up for a longer period of time. The price. Most bonds are issued at par. Okay? With an individual bond, par means a price of 100. Okay? So if you put $10,000 into a bond and it's issued at par, that's a price of 100. All right? If interest rates go up, guess what? This gets marked down. And so, you know, it can drop. So say, you know, then that means it's trading at a discount. Likewise, if you bought bonds within the last few years, you've had a great tailwind at your back. And if you look on your statement now, more than likely your bonds are going to be priced over 100, selling at a premium. Okay? A couple years ago, we picked up some Capital One bonds maturing in 2017. They had a 5 1/4 coupon. We were able to buy them at a discount of 85. So that's $8,500 is what we had to spend for a $10,000 bond. All right, I just sold those earlier this week for a price of $108. So, you know, there are opportunities. There's, you know, they're fairly few and far between today, but, you know, stay alert. And when there's an event, when something happens that causes asset prices to drop, you know, it's our natural tendency is to freeze up and just want to, you know, hold cash. But, you know, when you see a bottoming and any kind of a little turn after a big decline, that's the time to commit capital.
What does yield to maturity mean?
What yield to maturity means is that's really the common factor that you look at in evaluating a bond investment. All right? So if you're buying a bond at less than par, all right, this again, this Capital One bond had a 5 1/4 coupon. Okay? That's your coupon. All right? If you're buying it at 85, your yield to maturity, and again, that's a 2017 maturity, your yield to maturity is going to be higher than the 525 because you've got 15 points of appreciation back to par. Okay? But when you sell it at 108, I mean, you know, the person that bought that from me, you know, what's his yield to maturity? It's like 3.5%. Why? Because it's selling at a premium. So if you buy a bond at par, your yield to maturity equals your coupon.
Is it correctly to state that yield to maturity is the only way you can compare different bonds to
Yes.
as to
Yes.
what you're actually receiving?
Yes, because, you know, a lot of people will focus on the coupons.
But you should
But
be
you need to-
focusing on the
but-
yield to maturity.
Well, yeah, because the coupon's important, but then, you know, it's all, what price are you paying, right?
So the only way you can compare one
So
bond to another.
yield to maturity is the
yield
best
to maturity.
yardstick.
Okay.
Best yardstick to compare,
And
correct.
is that disclosed when you're looking at the price of
Yes,
the bond? That's
yes.
one of the numbers.
Very
that
much
was
so.
disclosed.
It's always disclosed. What's the quality of the bond? Does it carry a rating? You know, the rating companies have a lot of egg on their face right now because of the problems. You know, they rated all these subprime mortgage securities AAA, and look what happened. So it's just a starting point to consider with a bond investment. Again, the issuer and your confidence in the financial stability of the issuer is the number one factor to consider. With bonds, you should never pay a commission, an extra commission. The bond traders make their money by including their markup in the price that you pay.
Should a retail customer buy their own individual bonds?
I would say in certain circumstances, yes. You know, if you live in a certain town and your community is issuing general obligation bonds to fund, you know, some type of civic improvement, and you're comfortable with your city's finances, it's a great thing to have in your portfolio.
But if they get a call from Smith Barney, should they be buying individual bonds?
As a rule, probably not. No. But occasionally, you know, your communities will come out with bond issues, and you know, they can be very nice additions to your portfolio and help enable you to support your community. With bonds, like with stocks, there's a bid-ask spread in the pricing. What does that mean? There's two prices, depending on whether you're a buyer or a seller. All right? If you're buying, you're going to pay the ask price. If you're selling, you're going to ask for a bid. If you have bonds in your portfolio, if you have individual bonds in your portfolio, especially if they're long-term bonds right now, take a look at the prices. They're probably near record highs, and it may be a smart time to seek some bids. All right, we always get 3 bids when we go to sell a bond and take the highest one. So probably not a bad time to lighten up on your long-term bonds. Okay. All right, in regards to munis. Historically, munis have one of the lowest default rates of any types of bonds. Much lower than corporate bonds. Less than 0.5% of all munis have ever defaulted. But we're in some interesting times today. There's a lot of pressure on not only the state government, but also, you know, local governments. And so it's more important than ever to keep tabs on your issuers and know what's going on with their finances. You know, the 3 main types of muni bonds out there are general obligation, which means that those are backed by the full taxing power of the issuer. And they are considered the safest types of munis. Revenue bonds are also very safe. This would be like, you know, like a water or sewer revenue bond.
Toll road
bonds, where there's a dedicated source of revenue that's going to pay the interest and principal on the bonds. The riskiest type of muni bonds, where the pricing is very attractive right now, are land-based tax-backed bonds. These are also referred to as Mello-Roos bonds. Newer developments, you know, issue these bonds in order to fund infrastructure for, you know, street, sewers, all of that. And then there's an assessment that is made to each homeowner, which pays off the bondholders. Again, if you know a certain area, then you can feel more comfortable buying those bonds. Areas that were developed in like 2004, 2005, that issued these Mello-Roos bonds, there could be some significant problems down the road as homeowners default. But it would more than likely just be a temporary event because those payments stay with the property. Anyone that comes in to take over a foreclosed house has to make those payments whole. We typically will put bonds, muni bonds, of course, go in your taxable account. So your joint account, your trust. How many in the room have living trusts? Good. Hopefully everybody raises their hand. Your living trust account is where you buy muni bonds. And again, if you're a higher bracket payer, if you're in like the 25% or higher federal bracket, you add 9% state of California on top of that, all of a sudden a lower coupon on a muni bond looks very attractive in that type of tax bracket. So otherwise, we typically will put all of our bonds in the IRA account. For most clients, we handle 2 or 3 accounts. There'll be like a trust account, living trust account, and then an IRA for the husband and IRA for the wife. So your bonds are better placed in the IRA accounts. And why is that? Because except for tax-exempt munis, all the interest on the bonds is taxable if you have it in your trust account. If you have it in your IRA account, what happens? It's tax deferred. It's tax deferred. So all those interest payments that come in, you just accumulate, and then when you hit 70 and a half, you start taking out your required minimums.
So a person portfolio, they should look at it as one big investment pool and divide the bonds up into the IRA accounts as much as possible.
As much as possible.
Okay.
As much as possible. It also depends on a person's allocation. If they're at like 20/80 with 20% equities, we would look to put the 20% equities in the trust account, but more than likely, the 80% is going to also include some bonds in the trust account. So anyway, the point with the munis are that it started unraveling like in the fourth quarter of last year, November. Prices dropped and continued to drop into January. There was a 60 Minutes interview, I don't know if any of you saw it, with this analyst named Meredith Whitney, and she put tremors through the muni bond market, talking about potential defaults, and that exacerbated the price declines. But in mid-January, prices bottomed, and we've been gradually coming back up since then.
Are you buying municipal bonds today?
We've been buying them steadily over the last couple months because the prices really came down. And again, you just have to pick and choose your spots carefully. But
I remember tax bracket, correct?
Yeah. So, but there are still opportunities. The Build America program ended on December 31st. There are a lot of these bonds out there in the secondary market. So that's where you'd look for those now. There are a few new issues still coming that were authorized prior to December 31st. But by and large, the Build America program is over. Preferreds. Again, these are like long-term corporate obligations. All of the biggest corporations in America have issued these securities. They trade on the New York Stock Exchange. They're issued at $25 a share. They are long-term debt securities. So 30-year typical maturity, and some have a perpetual maturity. So I talk about extending duration. You get a higher yield with a preferred than you do with a bond. They pay quarterly taxable dividends. These dividends do not qualify for the favorable tax rates, by the way. So these are non-qualified dividends. So these, you know, if you own these are best held in an IRA type of account. We have sold pretty much all of our fixed rate preferreds because they're selling now at premiums. Most all of these are over $25 a share. There are some floating rate issues out there that still make sense. We own one issued by Goldman Sachs. It's paid about 4% on the current yield, priced at like $23.50. So you've got 6% appreciation left to get back to par, plus the 4%. I think that's going to return about 10% over the next year. And so floating rates still make sense here. You've had a previous session on open-end bond funds, correct?
Yes.
Okay, so we'll just breeze through this. You know, if you're uncomfortable buying individual bonds, this is probably what you own in the bond area. It's a diversified pool, actively managed. The fund issues and redeems shares daily at the net asset value. Net asset value is simply the share price. Okay?
Please stick to Vanguard, void Franklin Templeton, void load funds. These are basis points in fixed income.
Unless you're working with a fee advisor.
Yes.
Fee advisors have the ability to buy certain load funds at no load at the NAV. With your open-end funds, you know, many people don't even know who the portfolio manager is. And to us, that's critical, very critical. You know, it's the skipper, not the ship. So, you know, the reason you buy an actively managed fund is because of the excellence of the portfolio manager. And you need to keep tabs on that and make sure that the person that created the track record is still the one that's there. The great thing about these open-end funds is they're so simple. They're easy to buy, easy to sell. You get a monthly dividend, which represents your percentage yield. And remember, the yields that are quoted by these are all net of expenses. All right? Please, please, please beware of chasing strong past performance, especially now, because interest rates have come down again, bond prices are elevated. You know, you look at the quarterly fund summaries, and you see, oh, well, here's a top performer. You know, ask yourself, what are the chances of that performance being repeated moving forward? Well, you always have to look ahead, think ahead. Don't get caught being a rear view mirror investor and getting hung up on past performance. You know, look at the share price. Where is it now versus the 52-week range? Is it bumping up against 52-week highs? If it is, maybe it's time to trim that off. Sell some of those shares. All right? These things do move around. It'll come back down, and then you can add more when the price is lower. Have realistic future return expectations. Some examples. Short-term. Vanguard short-term investment grade. There's the ticker symbol. By the way, these are all no-load funds, meaning there's no sales charge or commission to buy or sell. All right, you can buy it 1 week and sell it the next week, and there's no fee. So, you know, you're getting 2.7% right now on this. It owns short-term government and corporate securities. Duration 2.0. What is the duration? How does the duration number matter? What it means is that if long-term interest rates were to go up by 1%, you take your duration, and that tells you what your principal would decline by. Okay? So if long-term interest rates go up by 1%, your principal would decline by 2% in that fund with a 2 duration. Likewise, if interest rates drop by 1%, your principal would go up by 2%. So not a lot of risk in this one, but again, the problem is it's near 52-week highs. So I'm not buying it right now. But if you're stuck in 0% or 0.5, whatever the banks are paying these days, this is helps get you a little more yield without much risk. Next is Templeton Global Bond Fund. And this is the advisor class. So you need, if you're not working with a fee advisor, find one, and that's how you get this fund. Otherwise, I believe Franklin Templeton, you're going to pay a load.
And that'll drop your current yield way down.
This fund here, this Templeton, is managed by a guy named Michael Hassenstad. He's a PhD. He's Morningstar's Fixed Income Manager of the Year. He has put together an unbelievable track record. And it's a global bond fund, so he has the ability to buy treasuries. Guess how much he has in treasuries right now? Zero. He's big into Australia, Brazil, and Norway. So you diversified out of the dollar, and it's a great fund. Problem here again, it's been on a tear. It's made a big move. You need to wait for a pullback before you commit any new money. A couple others. This is the mortgage-backed securities fund I mentioned, double line total return. Jeffrey Gundlach is the manager. He was on the cover of Barron's a few weeks ago, titled The New Bond King. All right? You stack up his performance here against Bill Gross at PIMCO, this one kills it. So if you're, he's got a great team. He was with TCW, had a falling out, set up Double Line as a new firm last April. This fund has been tearing up the track. And again, there's still opportunities in mortgage backs. Because of the discounts that are still available in these securities, the yields are high. That's how he's generating that 8% with a low duration. So it's high return, low risk. It's like the best of both worlds. So we are heavily invested in that one. But again, with any fund, it's not like a child, or a pet. You don't have to own it for life. Okay? You can sell it. All right. Lastly is a muni fund for people that are looking for tax exempt income. Again, this is a high yield muni, so it owns some of those land-based tax-backed bonds that we talked about, run by American Century. The interesting thing about this one is even though it has a fairly long duration of 8.1, the yield is fantastic for a tax-free, and it is not as interest rate sensitive as, say, a Vanguard fund, which is more investment grade. So if you watch this on a day-to-day basis, you'll see that it does not bounce around as much. It's more sensitive to the economics and the credit risks as opposed to the interest rate risk. Okay. Closed-end funds, we don't own any right now, but they trade on the exchange. They trade on the New York Stock Exchange. They're different than open-end funds in that they issue just a fixed number of shares, and then those shares trade on the exchange. So what happens with these is the market price will differ from the NAV. So you have an opportunity from time to time to buy them at a discount. So you can buy dollars for 90 cents. They're fairly thinly traded, so you always want to use a limit order as opposed to a market order. Remember, with a limit order, you specify the price you're going to pay. And these pay monthly dividends. There's an X date. So we like to buy them on the X date because remember, that's when the share price drops by the amount of the dividend. So you buy them right after they go X and get the lower price. And the thing to be careful of is that most of these closed-end funds use leverage, and that's a big red flag to us. We would not buy a leveraged closed-end fund. There are some out there with no leverage, and those are the ones you want to look at. Okay. ETFs, these are the new kid on the block. Peter's talked about them. They're flexible. You can buy them, sell them during the day. They're tax efficient, so they work really well in a taxable account and a tax favored account. Again, use limit orders. You can see the growth in ETFs. The first ones came out in '95. At the end of last year, there were 923 of these out there with almost $1 trillion in assets. So there's been a tremendous growth. One reason why is the low cost. You look at expense ratios here. ETFs are on the top. The expense ratios are on the bottom, starting at 0.1 up to 1.5. You can see the expense ratios down here of actively managed funds and index funds and of ETFs. ETFs are low cost and flexible.
Scott, let's go to the fixed income strategies slide.
Okay. There we go. For your strategy, own individual bonds. What's the maturity date of a bond fund? None. There's no maturity date. That's the big difference between an individual bond and a bond fund. With individual bonds, you have the certainty of maturity date when you know you're going to get your principal back, and you have the certainty of the interest payments. Bond funds can change the interest payments, and the share price will definitely move around on you. Stagger your maturities with individual bonds. You know, there's not a lot of value at the short end right now. The yields are so low. Intermediates is a good place to be. If you want to have some short, that's good. But consider a barbell strategy where you also have something a little longer to get some yield pickup. Own bond funds and ETFs for diversification, monthly dividends, and better liquidity. And like we talked about, beware the interest rate risk on long-term bonds. This shows what inflation does to your purchasing power over time. Somebody that retires with $100,000 in income, and with 3% inflation, you can see how your purchasing power declines over the years.
Could you go right to the dividend-paying stocks? I always love.
I'm getting there. All right. So here, this shows the returns of the asset classes over time. This shows the past 20 years, and this shows the past 10 years. Notice that large stocks have only returned 1.4% over the past 10 years. The worst performance of the major asset classes. What does that tell us? That's probably where the opportunities are for the next 10 years. Okay, so consider dividend-paying large company stocks. Normally I give some names. I'm not going to give any names today.
Really?
No, sorry.
You're not going to give any tips?
No.
Okay.
I mean, consider some late cycle industries that really haven't been caught up in this frenzy that we've had lately. Consumer staples would be one area to look at. Utilities, another area. Maybe some healthcare names that have been held back because of the the overhang from the
You got to give
Obama
one.
legislation.
What? Give us one tip.
I'm not going to give one.
Not even one? Okay.
No, there's
Johnson & Johnson?
There's a great ETF. If you want an ETF, SDY. SDY. That's the spider. That's the Dividends Aristocrat Index. This is an ETF that's comprised of companies that have raised their dividend every year for the last 25 years in a row. Okay?
Building a better portfolio, that'll end it.
Okay. Diversify. Hedge your bets. You have to. You've got to spread your money around. All right? Own what we've talked about. Bonds, funds, and ETFs. If you're sitting with too much money in low yielding investments, there's a big world out there. And consider muni bonds for tax exempt income. There's still some good pricing inefficiencies in the muni bond market. And then on dividend paying blue chip stocks for good quarterly income that will grow because good companies will increase their dividends year after year. So you have a built-in inflation hedge with that dividend increases and the future capital appreciation. And get active, study it, or hire it out. Some helpful free websites, and lastly,
Commercial.
you're eligible for 1 hour portfolio review. Thank you for your time.
Wait a second, we're not gonna let you off just so quickly. What is the purpose of the fixed income portfolio in an asset allocation model? Is it just to bring income?
Safety,
Safety?
income, and a hedge against stock market risk. Because, like we said, when everything tanked in 2008, treasuries were strong. That's not an argument to say and go out and buy treasuries today, but you look at the volatility of bonds and of these fixed income securities that we've talked about versus stocks, and they're a lot less volatile.
Yeah.
So it's a safer component of the portfolio.
Yeah, we had a woman in the previous class, and she came up to me afterwards and she said, "Isn't there anywhere I can get a safe return for over 1%?" And so, and it's not likely. I said, "Well, what is your net worth?" That's one of the first questions. I mean, how desperately do you need the income? And she said, 40 million. And I said, 40 million, and you're worried about 1% income, or getting 1% on her money safely. I said, why are you so concerned? And she says, it's just not any fun getting so low of return. And we tend to focus in on that yield. But remember, your fixed income portfolio prevents that whole portfolio from going down. It provides that safety nest. And so think of your fixed income portfolio as the steady part of your overall. And it's very difficult today to invest in this area. So, Scott, thank you for a great job. Okay.